Hey everybody, what's going on? It's James here, and I wanted to shoot a quick video because I just published my latest blog post over on thequietquant.com. And I'm sharing a strategy in this blog post that I first shared many years ago. I developed this strategy after a catastrophic early 2018. In early 2018, as a new trader or a new investor, really, I bought into the hype and I drank the Kool-Aid. And as a result, I lost hundreds of thousands of dollars. And so I went away from chasing narratives and started trading math and started trading facts and technicals and, reality. And one of the systems that I developed for people that didn't want to sit and stare at charts, but still wanted to be market participants, was this grid strategy. Now, grid trading is not something that I invented. A lot of people grid trade, but this specific strategy is something that I invented. And so I'll go over the post real quick and I'll show you a chart. And there's nothing for sale, so it's not a pitch. I'm happy to share this free of charge as my way of putting goodness out into the universe. So obviously the title of the post, Grid Trading Fundamentals, a Systematic Approach to Market Volatility. And what I'm going to do is I'm just going to jump down to how the system works. So the system itself, I base it off of a 5-level grid. And so the grids, if all 5 levels are hit, it caps the investment at no more than 3% of my total investment portfolio. So for easy math, if I have a $100,000 portfolio, I'm not going to allot more than $3,000 maximum to any one asset. And so that's what capital allocation, maximum 3%. This level spacing, this actually changes in a bear market. I actually changed the first drop to a 90% drop in crypto and 50% drop in stocks. But I didn't get super detailed in the post for that. So level spacing, each level triggered by a 50% drop from the previous level. Position scaling, it's geometric progression. So it's 1x, 2x, 4x, 8x, 16x, almost like Fibonacci levels in a way. And then mathematical result, 77.4% of capital is deployed in the bottom 2 levels. And that's extremely important, and you'll see why in a moment. So here's an example. Let's say a stock peaked at $100 or a cryptocurrency or whatever you're trading, 3% capital allocation. Let's just say hypothetically that it was $10,000 total investment. Then at level 1, $50, I would deploy $323, which is 1x position. At level 2, which would be $25 on the stock price, I would deploy $646, which is a 2x position. At level 3, when the stock hits $1250, I would deploy $1,292, which is 4x, so on and so forth, okay, as the math explains. If it hit all 5 levels, then I would have $10,013 invested, and my average cost per share would be $7.36, which is more than 92% from the all-time high. It's really important. The mathematical power, why it works on everything. So the geometric scaling is so mathematically powerful that it can generate profits even on fundamentally weak assets. Okay, so it's not about picking the winners. It's about mathematical structure, creating advantage through severe drawdowns. And again, I developed this because of all the money I lost in early 2018. I had a huge percent of my portfolio in altcoins, and altcoins, of course, a lot of them dropped over 90% versus Bitcoin and never recovered. So this strategy would have actually allowed me to make money versus losing money. So as an example, I picked a stock that's performed very poorly the last few years, and that stock was PTON, right? Peloton or Peloton, or however you say that. I think it was like an exercise equipment company. So it peaked at $171. This is back in like 2021, and then crashed 95%. Its current level around $778. And so a grid strategy would have triggered all 5 levels. You can see these entries here, and it gave it a weighted average cost of $7.36 a share. So the current price is $7.78. So basically on a dog, right, almost a worst case scenario, the system is still at 5.7% in this theoretical example, okay? So again, the mathematical accumulation looks like this. Position size is 1x plus 2x plus 4x plus 8x plus 16x equals 31x base units. So this is how you figure out your initial position. If you have an account, you divide it by 31, and that gives you what the first level is. So bottom two levels are 24x out of 31x. Again, that represents 77% of total capital, and the average cost is heavily weighted toward those bottom levels. All right. So again, you can read through all this, right? It talks about the triggers, like the first level is 50%, 75, 87, 93, and 96. And it talks about different types of stocks and assets and, kind of the pros and cons to those. It talks about when the strategy fails, which is essentially when an asset goes to near zero and stays there or completely dies. And then again, the risk management section, no more than 3% maximum per asset, no more than 20 to 30 total positions. And, ideally, I don't want to have a bunch of positions in correlated assets, because then my risk is not really 3%. If I have 5 correlated assets, it's really 15%, right? And then here's an example on that chart. So we'll open this up and zoom in. So you can see this was that stock. Again, this was back in, I think, 2021 or 2020 during the pandemic, right? Peaked up around $171. So the first buy would have been, and I just used nice round numbers here, starting with the $100 investment. First buy at $85, bought 1.16 shares, then buy at 42, then 21, then 10, then $5 per share. All those were hit. That's what these green levels are on the chart. And so at the end of the day, in this hypothetical example, it would have been $3,100 invested for 398.45 shares and an average cost of $7.78 per share. And right now it's sitting around $7.60 per share. But it was actually above that not too long ago, up to around 11 or 12 bucks a share. All right. So this is something that as a trader, I could either sit on this and say, you know what, I think it has a future, and I can, try to ride it and sell pieces as it goes back up. Or if I'm just like, hey, I think it is a turd, I think it's done, then I could exit for roughly break even, or a little bit less than break even right now. But again, I would have had an opportunity to get out for profit back here. So it works unless the asset either dies or goes to near zero and just stays there. So I'm going to pull up a chart of OMG, because OMG is one of the tokens that I really, really got myself in trouble on. I was a big OMG guy back in 2017. I made a lot of money on OMG. And so I just kept reinvesting. And again, I did end up losing several Bitcoin in 2018 because of this. But again, going off a 90% first drop for cryptocurrency bear markets, this is what it would have looked like. This chart does not go back far enough. Let's see if we can find a chart that goes back. Everybody's pretty much delisted this. Wonderful. Well, that really sucks, because I'm not going to be able to show you OMG. What I was going to show you is how it hit every level. And even though it's now currently down like 99% versus Bitcoin, it still had an opportunity to get out for even before it fell that low. I wonder if there's another one I can use, like Zcash, another one that's just completely, falling apart. At one point in time, it was actually worth 25 or 26 Bitcoin back here. But looking at it, by the time, let's put this on a log chart, by the time all 5 levels were hit right here, that means the cost average would have been somewhere down around like this area through here, because of the way the weighting works. And then you can see there was a massive pump of over 300%. So somebody had been investing in each level, they actually had an opportunity to make over a 300% return on that, even though it never recovered. This is Zcash today versus Bitcoin. It doesn't matter if an asset dies or goes near zero, as long as there's some type of bounce first. There's a very good opportunity to, come out ahead with this particular strategy. So I wanted to share this with you and just get some goodwill back into the market, because this market has been very good to me, and it has put me in a better position financially in life than what I was ever in before coming into markets and before learning how to trade. And this is something that anybody can do. It doesn't require a lot of time, and it doesn't require a lot of skill. It just requires some discipline. And for most people, they'd be better off approaching the markets systematically versus approaching the markets emotionally. And I know in my last video, I had a lot of support, so thank you for that. I had some comments. Thank you for the comments. For those that disagreed but were respectful, I appreciate the conversation, truly do. Life is short, and so I appreciate you taking time to leave your thoughts. And for those of you that chose not to leave any productive comments, but just to insult me, you're just showing the world that you have a low IQ. In my experience, successful and happy people don't go around leaving nasty comments on the internet. That's typically reserved for people that aren't exactly doing the best in life. So my heart goes out to you. I hope things get better for you and you become a positive impact on those around you. As always, please remember that I am some guy sitting in a spare bedroom and nothing in this video is financial advice. This is simply a system that I've developed that I've had some luck with. I'm not saying it will work for you. Feel free to take it and tweak it to your heart's content. Maybe sit down with a financial advisor, get their thoughts on it. And as always, please do your own due diligence. If you haven't already, make sure you subscribe to the channel and drop me a thumbs up. Leave me a comment. Let me know what you think. And I'll wrap up today by saying something different. A, trade safe, which is what I always say. But B, life is short and it's so much better if you spend your time trying to improve other people's lives instead of trying to tear other people down. This is James with Crypto Common Sense. I'll see you soon.